If you're going to invest in individual stocks or even index funds, there are some key terms you need to learn and understand in order to be successful at comparing investments. Authorized shares are the total number of shares that the company is allowed to issue as defined in the company formation documents. For public companies, in order to change the number of authorized shares, the shareholders would need to vote to approve it. Issued shares are authorized shares that are held by institutional investors, insiders, or the general public and include the treasury stock of the company. In a sense, when you combine outstanding shares and treasury stock, you get issued shares. Many of these types of terms require understanding the others in order to make sense. The outstanding shares are held by or sold to a company's shareholders, but do not include treasury stock. Outstanding shares is more inclusive than floating stock, but less inclusive than issued stock. I know all of this sounds pretty confusing. Drop a comment if you'd like to see a more detailed video breakdown. Treasury stock refers to the shares that are held by the company itself. These shares can be set aside for compensating employees through RSUs or stock options. When a company does stock buybacks, it is usually but not always adding those shares to the treasury stock. It is starting to feel like every financial term that I define leads to more that I need to define. Drop comments if everything I'm saying sounds like a foreign language. I swear that is not my intent. Floating stock refers to the outstanding shares that are available for trading. Float does not include things like the major shareholders and insider shares or restricted stock of employees. The amount of float that a given company has impacts the volatility. For example, if we compare a company with 100 million in float versus a company with 10 billion in float, a $100,000 trade would be a significant proportional difference. That trade might barely impact the share price of the company with 10 billion in float, and it might significantly impact the share price of the company with 100 million in float. One key term is market capitalization, or market cap for short. This refers to the market value in dollars of a company's outstanding shares. In other words, the share price multiplied by the total number of shares on the market. Effectively, this can be viewed as the dollar amount to purchase an entire company, although there are many more considerations that come into play when purchasing a public company. A clear example of this was when Elon Musk purchased Twitter. If you're interested in seeing me break down that situation, drop a comment. Earnings per share is calculated by dividing the net income by the total outstanding shares. There are actually a number of ways that this can be calculated, and I'll leave that for other videos. This can be a negative number for companies that are not reporting a profit. That does not necessarily mean that the company is in trouble. Generally speaking, companies will reinvest earnings to keep corporate taxable income as low as possible. The price to earnings ratio is calculated by dividing the share price by the earnings per share. It can be calculated as trailing, oftentimes expressed as PE/TTM for trailing 12 months. It can also be expressed as a forward-looking estimate. This is an extremely useful metric for business valuation, but depending on the sector, it can be less meaningful. Drop a comment if you want to see an in-depth video on business value analysis. For investing, shareholder equity of a company is calculated by taking the total assets value and subtracting the total liabilities. This is very similar to a homeowner's equity being calculated by taking the home value and subtracting the mortgage loan balance from it to get the homeowner's equity. Debt to equity, or the DE ratio, is calculated by taking the total liabilities and dividing it by the shareholder's equity. The company's balance sheet will have both of these metrics, so the debt to equity ratio can be simple to calculate. Book value per share is calculated by taking the shareholder equity and subtracting the preferred stock and then dividing by the total outstanding shares for the company. Price to book, or the PB ratio, is calculated by dividing the share price of a company by the book value per share. For business sectors that rely on various assets, this can be a useful metric for assessing the value of a company. You'll find that many sectors like the tech industry have crazy ratios. For example, at the time of this recording, Apple is at a PB of 41, but Ford is at a PB of 1.11. By this ratio, it would indicate that Ford is a better value, but these ratios are really only useful when comparing within a sector, and these companies are very different businesses. Free cash flow. Since there are no regulatory reporting requirements for free cash flow, it is not a metric you'll find directly on an income statement, balance sheet, or cash flow statement. I will say that bookkeeping and accounting are sort of my kryptonite, so take everything with a grain of salt. There are many different ways to calculate free cash flow, each of which probably warrant a video getting into accounting principles, but in simple terms, free cash flow can be calculated by taking the cash flow from operations, add back the interest expense, but subtract the tax shield on the interest expense, and then subtract the capital expenditures. Just saying all that makes me dizzy, so drop a comment if you are thoroughly confused. Price earnings growth, or PEG ratio. Earnings growth, which is part of PEG, is calculated by looking at the earnings per share for this period and comparing it to the previous period. Usually we compare years. The PEG ratio is then calculated by dividing the PE ratio by the earnings growth rate. Higher growth will mean a lower PEG ratio. At its core, investing is about growth. So since this ratio factors that in, it's extremely useful in comparing investments. When I set out to define investing terms in this series, I knew that I wanted to talk about the foundation of my investing and trading strategies. That is value investing. This strategy was devised by Benjamin Graham in the late 1920s and early 1930s. The most well-known modern investor that continues this investing philosophy is Warren Buffett. The metrics that we have discussed can play a key role in determining what the value of a company is. These metrics are generally only useful when comparing within a given sector and when comparing to historical ratios. Value investors believe that there are times that the markets will overvalue or undervalue certain companies or sectors. We use the metrics to assess those times and to determine when to enter or exit a position. Warren Buffett's saying, "Be fearful when others are greedy, and greedy when others are fearful," is a good way to summarize this investing philosophy. Let's walk through a practical example at the macro scale. The charts that you see here are the average PE ratio for the companies that make up the S&P 500 index. We can see that in Q2 of 2009, the PE ratio was over 120. The ratio at the end of 2020 was just under 40, and most recent numbers are around 20. Since the 1980s, the PE ratio average for the S&P 500 has been around 22. It really shows how crazy the PE multiples became in the run-up to the financial crisis. To put a 120 PE ratio in perspective, let's walk through some numbers as if we were going to buy a small business that was doing $100,000 in net income. You would be paying over $12 million to buy the business at that ratio. That sounds like a terrible investment to me. That comparison is just for perspective, as the multiples for purchasing a small business would not tend to be this high. And it's also good to keep in mind that many businesses purposefully are not profitable due to reinvesting all of their cash. I mentioned that the concepts of value investing also apply to my short-term trading strategies. That is because I use value investing to determine companies that I would be happy to hold at their current market valuation. But then I employ my options trading strategy to enhance profits and gains. This uses a combination of selling put contracts to enter positions and then selling covered calls once I own the shares. We have a full video explaining options concepts and using this strategy. Check out the video description or the video here. We believe in creating abundance and designing a lifestyle we enjoy now and in retirement. There are a lot of personal finance channels that seem to imply that automated index fund investing is the only path to wealth for anyone and everyone. There's certainly a place for that strategy, and if you want to budget yourself to financial independence, it can be one of the most surefire paths. On this channel, we focus on a number of unconventional strategies to build lifestyle and wealth alongside one another. I would rather learn to live than live to work. So if that interests you, drop a like, hit that subscribe button, and check out some of our other content.